Man, oh man, the stock market has been crazy this past week. We got a lot to talk about. I actually had a different video planned to film for this week, but I knew I couldn't do that because there was so much shenanigans going on in the stock market that I just had to address some things. If you're new here, my name is Justin Wynn. I'm glad you came across our channel. Make sure to hit that subscribe button so that you can keep up with all of the future content. As you guys know, this past week we saw an ugly sell-off when it comes to many growth stocks within the market. You got Tesla selling off nearly 25% this week. Shopify was down 21%. Square was down 25%. ARK was down nearly 23%. And if you look at some of the crazier high-flying growth stocks, they fell even more. eXp Realty fell down nearly 44%. Opendoor fell down 46%. Nano Dimensions fell down 38%. Zomedica fell down 36%, and CCIV fell down 36%. Some of these companies have lost billions of dollars in their market cap in just 2 weeks. Unfortunately, I've seen some people on online forums and groups that said their portfolios were down 30 to 50% in the past 2 weeks. I had mentioned last month that the overall stock market has been driven by a lot of greed and euphoria, and that stock prices were being driven way too high, and it got to extreme valuations that were not justifiable, and so we were bound for a correction. As an investor, one of the most important things that we need to know is that valuations matter. Over the last few months, valuations have been tossed out the window. In times like that, it seems like everyone is a genius because you can buy whatever stock in the market and you'll see it go up, up, and up. But here's the problem with that. You can't expect high-flying stocks to keep flying. It seems like the past few months, every stock is just going to the moon. And when there's a lot of euphoria in the market, a lot of stocks do land on the moon. But it's not likely that they're gonna keep flying to infinity and beyond. And that is why valuations are so important. There comes a moment for investors when they realize that some of these stocks that have moon landing valuations are not justifiable. And so those stocks plummet hard. And here's something that is very concerning for me when it comes to new investors. They look at some of these high-flying growth companies that have fallen 20 to 25% in the last week, and they think, oh man, buy the dip. They say things like stocks are on sale. And when I see that, I think, oh no. A stock that was on the moon that has crashed really hard and fallen 50% is still only in the stratosphere. It's not grounded in reality yet. Here's something scary to think about when it comes to valuations. Just because a stock dropped by 20 to 25%, it does not mean that it's a good deal. So we have all these investors who are buying and they're like, it keeps dipping. This is a 7-layer dip. The reality is there are a lot of speculative companies out there that should not have been trading at the valuations that they were trading at. And here's a big mistake that some people do. They'll look at the charts of highly speculative companies that have fallen immensely and think to themselves, this is at some point going to recover. And the problem is, with those highly speculative companies, returning to the moon is not common. So in the past few months, we've had some stocks that were trading at valuations that they never should have even been close to those types of prices. And then other growth companies, they were just trading way ahead of themselves, and they'll get to those prices, but just not yet. So I need to show you something. Look at the NASDAQ during the dot-com tech bubble in 2000. If you bought the NASDAQ back then, it would have taken over a decade just to break even. And look at another high growth ETF like QQQ. If you bought QQQ back then, it would have taken nearly 2 decades to break even. And here's why I share the NASDAQ and QQQ with you, because it's very important to understand that growth stocks can make you a lot of money, but you need to understand valuations, when it's a good time to buy them and when it's the time to sell them. There's times in the stock market when growth stocks are just grossly undervalued, and that's the time that you buy them. And there's other times in the market when growth stocks are way overvalued. They're on the moon. I call them moon landing valuations, and that's when you sell them. And here's my big concern with everything going on. There's still a lot of growth stocks out there that have sold off immensely, but they're still not a good deal. Think of the sales tactic of a salesman who intentionally marks up their price, and then they'll tell you, oh, I'll give you this for 30% off if you buy it right now. Some people are like, well, dang, of course I'm gonna buy it because I'm getting 30% off. And they go home happy thinking that they got a good deal. Well, is it actually a good deal? Or did the seller mark up the price so high that even a 30% discount doesn't justify the price. Similar is true when you play with growth stocks. Some valuations are still way too astronomical even with a 30% cut. So with the recent sell-off in growth stocks, some of them are still trading extremely rich, but because the whole sector is down, it has provided some good buying opportunities within growth stocks. I'm going to share with you 8 different stocks that I either own, have been buying in this recent dip, or am looking at because things are getting very attractive in regards to their valuations. But before I do, make sure you hit that like button. It really helps out small and new channels like mine be able to beat the YouTube algorithm. I really appreciate all of your support. And remember, I am not a financial advisor. Everything I'm going to share when it comes to these 8 stocks that I'm interested in or buying is just my opinion. Make sure to do your own due diligence before you buy or make any investment in any company. Alright, so the first stock on my list is Facebook, ticker symbol FB. This stock should not be trading at where it is at. It is so cheap. It is currently trading at $264.28. The reason this company is so cheap is because it's trading at a forward PE of 22.78. I think Facebook has been so overlooked because it's not as exciting as some of the other names out there and because there's been a lot of negative sentiment around it. But that's fine with me because I get to buy so many more shares of it at a cheap price. I currently own 45 shares in this public account and I own many more in the retirement accounts. What's funny to me is that there's been a lot of focus on these newer companies that have been putting up really big numbers for their revenue growth, but Facebook has been as well. Their revenue increased by 33% in just this past quarter. They made $28.1 billion. Even though this company has been on the stock market for a while, in comparison to some of these new companies that recently IPO'd, it's still putting up crazy numbers just like these newer companies. It's kind of like Tom Brady, old in comparison to all of his competition and these new up and coming players, but he's still good. But Facebook provides way more stability in comparison to some of these new speculative companies because it is well established and has $0 of debt. This company has been suppressed over the last few months because of all the things that are happening politically, with all the lawsuits happening, and people questioning the sustainability of its ad revenue. But the reality is these are such short-term perspectives and Facebook is going to weather all of these storms. Facebook has so much money in the bank and their real growth, as if 33% increase in the revenue isn't enough, is actually in their other parts of their business. The revenue they got from their other businesses grew 156%. People get excited over stocks like NEO who are doing triple digits of growth, but Facebook is doing the same thing. It's just not as popular and not as noticed. According to the investment research center Morningstar, they give Facebook a fair value estimate of 335 as well as a 4-star buy rating. I've been slowly adding to my Facebook position during this dip and I'll continue to add if it goes down more. The second stock that I've been adding on this dip is Amazon, ticker symbol AMZN. It is currently trading at $3,000.46 and it is down 13% from its all-time highs. This is a high quality stock similar to Facebook that has taken a small hit in this recent sell-off. Even though Amazon is a giant, this beast is still putting up some very impressive stats. Side note, did you know that hippos can run almost as fast as tigers? Hippos run at 31 miles an hour and tigers are between 30 and 40 miles an hour. Facebook and Amazon stock are like hippos. They big, but you best believe they can run. Amazon smashed their earnings forecast. Their earnings forecast was $7.23 and they reported at $14.09. That's crazy. They had the most profitable quarter in the company's entire history. It says here this company delivered its largest quarter by revenue of all time at $125.56 billion, pushing it past the symbolic $100 billion mark for the first time. When you compare their earnings this quarter last year, their sales increased 33 to around 40%. They've also been hiring like crazy. Amazon now counts nearly 1.3 million employees across the globe. That's an increase of 63% year over year. This hippo of a stock is running fast. They're expanding into the medical space at extreme speed. As you can see here, Amazon's telehealth arm quietly expands to 21 more states. So needless to say, this beast of a stock is still growing and it's not slowing down at all. Morningstar gives Amazon a fair value price target of $4,000. They say it's undervalued at about 25%, and so they give it a 4-star buy rating. The first time I bought Amazon was a couple years ago. My biggest mistake is that I sold it for a profit. This is one of those companies that you should just hold for a long time because it's gonna consistently grow and return a lot of shareholder value. So with the recent sell-off, I actually bought back in. I currently own 3 shares with a cost basis of $3,046.45. If the share price continues to show weakness, I'm going to continue to add to this position because Amazon's a great stock that every portfolio should probably have. And the third stock on my list is Microsoft, ticker symbol MSFT. Microsoft is another giant. It's in the tech sector and it's only fallen slightly since this past sell-off. It's currently trading at $231.60. It is only fallen 5% this past week. This stock was trading sideways for a while and broke upwards, but seems to be coming back down. If it gets to around where it was consolidating for a few months at around $215, I gotta pick up some more shares at those prices. Microsoft is such a safe play for the long term. This company still grows double digits at a consistent pace. In their last earnings report, Microsoft reported a 17% revenue growth as their cloud business accelerated. This company isn't going anywhere and it reminds me of Johnson & Johnson. It's kind of like the tech version of it in regards to its safety and reliability. It also pays a small dividend, which is nice. Every share of Microsoft will give you $2.24 annually. Morningstar gives Microsoft a fair value estimate of $263. They say it's currently undervalued at about 12%, and so they give it a 4-star buy rating. I currently own 11 shares with a cost basis of $197.67. I'm watching this stock closely. I'm willing to add to my position if it dips below $215. So the fourth stock on my list is Tattooed Chef, ticker symbol TTCF. This company is a growth beast and will continue to grow over the next decade. Tattooed Chef is one of the 3 stock picks that I made in my last video. In that video, I talk about why I believe Tattooed Chef is a great purchase at these prices for a long-term growth play, so make sure you go check it out. I like many things about Tattooed Chef, but I'll just mention 3 quick things in this video right now. The first is their revenue growth. Tattooed Chef is currently trading at $19.12, and they're down almost 32% from their all-time highs. They grew their revenues in Q3 65% year over year. As you can see on this chart here, they've been growing their revenues like crazy. In just the last 5 years, their compound annual growth rate was 63%. And they're also expanding their product line every single year, which is going to contribute to their revenues. As you can see in this product introduction here, in 2017, they only had 2 products. And just within 4 years, they're going to have a total of 62 SKUs. The next thing I like about Tattooed Chef is that they have a lot of money in the bank. As of right now, Tattooed Chef has $200 million in cash. That's crazy considering their market cap is sitting at $1.5 billion. And the last reason that I'll share as to why I like Tattooed Chef is that all the money they've made so far, they made it without any type of marketing. And so in 2021, they have a whole marketing strategy as to how to expand and scale their business so that Tattooed Chef becomes a household name. I've nearly doubled my position in Tattooed Chef since I last recommended it. I currently own 275 shares of Tattooed Chef with a cost basis of $20.23. And like I've shared before, anything under 20, in my opinion, is a steal when it comes to a long-term play. The fifth stock on my list is Palantir, ticker symbol PLTR. Palantir is currently trading at $23.95. and is down almost 39% from its all-time highs. And this is another company that I mentioned in my last video, so make sure you go check it out because I give a more detailed analysis as to why I believe it has great future growth potential. This company works in big data and has so much potential for growth. Their revenues are currently heavily reliant upon the government, but they're expanding into the commercial space very quickly. Last year, their commercial clientele grew by over 100%. They also recently landed 15 different contracts that are very profitable. On top of that, just 2 days ago, Palantir teamed up with a huge company, and that company is Amazon. As you can see here, Palantir Technologies announced Friday its new enterprise resource planning system with Amazon. Amazon is a $1 trillion client. This company is only in its early stages of growth, because data is going to be everywhere in the future, and Palantir has so much potential clientele. Palantir has what is called an incredible TAM opportunity. TAM stands for Total Available Market. As of right now, Palantir has only less than 20 clients, but these clients are big dogs. And over the upcoming years, Palantir will increase its clientele immensely, which is going to skyrocket their revenue. Palantir is going to dominate in the years to come because they are the leaders in the data space. I've been adding Palantir on this dip, and so I'm up to 150 shares with a cost basis of $25.56. This is one of my favorite long-term growth play stocks right now that I'm building a position in. If it continues to show weakness, I'm going to continue adding. And the sixth stock on my list is Unity, ticker symbol U. It is currently trading at $93.82. And it is down nearly 46% from its all-time highs. I started adding more to my position in this recent dip. I now own 40 shares with a cost basis of $107.68. Unity is a software platform that creates 2D, 3D, AR, and VR projects. They are the leading player when it comes to game development and all things augmented reality and virtual reality. And those industries are growing rapidly. Their software is so versatile that it's used in different industries as well, like film, music, and car manufacturing. This is a long-term growth play. Even with the sell-off, this company is trading at rich valuations, but I'm willing to pay the premium because it's a quality company that will perform well over the long run, and I'm going to continue to add to this position if it continues to get beaten down. The seventh stock on my list is the riskiest stock that I have. I bought this stock because I wanted some exposure to the electric vehicle market in China, and this stock is XPeng. Ticker symbol XPEV. XPeng is currently trading at $28.03, and it is down 61% from its all-time highs. XPeng is a Chinese EV player that currently has 2 cars that they're producing and selling. And honestly, their cars are pretty nice. The first car that they have is the G3, and it's their smart SUV. And the second car that they just released recently is their P7, and it's their sedan. XPeng is a really risky stock play that I have because I wanted exposure to the largest market available to sell EVs, which is China, and XPeng has a great quality product that is selling very well. People in China and Europe are loving the P7. As you can see here, the P7 achieved 20,000 sales quicker than any other vehicle from a Chinese EV startup. And the amount of vehicles that they're selling is growing so fast. XPeng delivered 2,223 vehicles in February and 6,015 vehicles in January. That was a 577% increase over the first 2 months last year in 2020. This company is seeing extreme success in the vehicles that they're producing. The P7 kind of reminds me of Tesla when they released their Model 3. In the early days of Tesla, when they only had the Model S, they only sold a few vehicles, but the moment that they released the Model 3, they saw insane sales growth. I live in California, and the Tesla Model 3 became the most sold vehicle, beating the Honda Civic last year. In the same way, XPeng's G3 didn't sell too many vehicles, but when their P7 was released, we started seeing a lot of growth in terms of their sales. I like XPeng because I believe over the next few years, we're going to see an increase in demand for their vehicles. They're also trading 3 times cheaper than its competitor NIO. XPeng's market cap right now is sitting under $20 billion, whereas NIO is trading at a market cap of nearly $60 billion. And if I were to compare XPeng's market cap next to Tesla's market cap, Tesla's sitting at nearly $574 billion after this recent sell-off. So when I compare the market caps of all the different EV players, XPeng is my favorite. I'm currently down on my position, but I'm not worried about it. I'm actually looking about adding more. I currently hold 100 shares with a cost basis of $37.61. As I mentioned before, this is my riskiest stock play, but it's one that I'm willing to take, and I'm going to continue to add to my position and dollar cost average down if it continues to show weakness this upcoming week. And the last stock on my list, the 8th stock that I have to share with you, is Costco, ticker symbol COST. Costco is currently trading at $317.32. It is currently down 19% from its all-time highs. A nice thing about Costco is that they pay a dividend. Every share that you have pays an annual dividend of $2.80. And every few years they give a special dividend. They did one 3 months ago in December and it was $10. I've been watching Costco for a long time and I've been waiting for a moment that it would sell off so that I could enter in. I wanted to buy it last year during the pandemic crash, but it only dropped 12% from its all-time highs. But right now, it's down almost 20%. Costco reached a bottom at $284 last year during the crash. Because I didn't get in then, I kind of regret it, but I'm willing to start a position now. Costco is one of those companies that's a high quality company that's going to be here for a long time, and it's a safer stock play. Part of the reason why this stock has been selling off recently because it didn't meet Wall Street expectations. But just because it didn't meet expectations, it doesn't mean that this company isn't performing well. They've been increasing their sales by double digits as well as their online sales. As you can see here, the total comparable sales rose 13%, and this is where it gets crazy. Their e-commerce sales rose nearly 76%. Morningstar gives Costco a fair value estimate of $332. The red line represents Costco's fair value and the black line represents where Costco closed in terms of stock price. On this chart, in the last 10 years, you can literally count the amount of times it's dipped below the red, and now is one of those times it has in the last 10 years, which means it's a good buying opportunity. With that being said, this sell-off that's happening in Costco, in my opinion, I think it's an overreaction, which is great for investors to come in now and begin to purchase up positions within the company. And so there you have it. Those are the 8 different stocks that I'm going to continue to add to my portfolio if this stock crash continues.